Welcome back to Gold Rush Reporter, everyone. Before we dive in, make sure to hit that like button and subscribe if you haven't already. Your support keeps this channel growing and helps us bring the latest insights on silver, gold, and the precious metals market straight to you. Today, we have a very special guest joining us, my good friend Bart Brands. Bart is a certified security intelligence professional and a precious metal specialist at Gold Republic. He's been tracking market trends and uncovering the structural shifts in metals for years, and we're lucky to have him here to break down what's happening in gold and silver right now. Bart, welcome back, man. Thanks, Ivan. It's great to be back. There's a lot happening in the market, and it's truly an exciting time to live through these changes. Absolutely. And let's jump right in. If you've been watching silver recently, you know it's been a wild ride. Prices have been volatile, swings are happening intraday, and a lot of investors are asking, what the heck is going on? On December 26th, CME changed the rules on margin calls, and just a few days later, on the 29th, silver got slammed. Then, by the 30th, it was up again. Bart, walk us through what's happening here. Well, Ivan, what we're seeing is a classic case of changing the rules during the game. This isn't new. It's happened before in 1980, in 2011, and now it's happening again. The changes tell us something important. There is massive demand for precious metals, but there are forces actively suppressing the prices. The suppression highlights how desperate the current system is to maintain its control. Yet silver keeps showing that it is losing that tug of war. That's huge. It's not just about market movements. This is signaling a permanent shift in the global monetary system. Anyone not already positioned in silver and gold risks being left behind as these metals assert their fundamental importance. And as you said, Bart, even naked shorting or trying to manipulate big long contracts doesn't work anymore. The market is shifting and silver is running out. Its versatility and scarcity make it more crucial than ever to hold. Exactly. Silver isn't just a commodity. It's a cornerstone for wealth preservation. And for everyone watching, remember this. When you measure your holdings, don't think in dollars, euros, or any fiat currency. Measure your wealth in ounces, kilograms, grams, physical silver itself. The recent correction we saw wasn't driven by fundamentals. It was purely market mechanics and rule changes. But if you're stacking with a goal, say 100 ounces, then a 10% dip is just an opportunity to add more weight. The currency price may fluctuate, but the value in real ounces doesn't. That's a key point, Bart. Investors need to have structure, goals, and discipline. Don't get caught in the panic of the market or the herd mentality. Focus on accumulating real wealth, physical silver and gold, not chasing fiat pricing swings. And speaking of herd mentality, that's one of my biggest concerns going into 2026. As silver and gold become more mainstream, new investors will enter, often chasing price spikes. Stackers, we need to educate and guide these newcomers. Make sure they understand the fundamentals of precious metals and their role in a new monetary system, not just buying because the market is moving. Absolutely. This is why communities like ours and channels like Gold Republic are so important. Education is the first defense against emotional investing and herd behavior. And for those watching, remember, the goal isn't just to buy, it's to hold, understand, and participate in a worldwide shift toward tangible monetary assets. Now, let's talk about what actually happened in the silver market over the last week. As Bart mentioned, the rules changed mid-December regarding margin calls and contracts, and the effects were immediate. On the 29th, silver got smashed. Many traders reacted emotionally, thinking the fundamentals had shifted. But the reality is simple. Nothing changed in the physical supply or demand of silver. What changed was the regulatory environment. And that's a key lesson for all investors. Don't panic during short-term market chaos. When we look at the fundamentals, silver's story hasn't changed. Demand is still strong, especially from industrial sectors like photovoltaics, electronics, and EV production. Silver remains finite, and with every passing year, more of it is locked away in investor hands, vaults, and central banks. That tightening of available supply is why physical silver continues to outperform paper contracts. This is where the diamond fist concept comes in. Hold your silver, no matter what short-term price fluctuations do. Bart also brought up an essential point. Measure your stack in weight, not fiat. That cannot be overstated. Let's say you aim to accumulate 100 ounces of silver. If you currently own 50 ounces and the market dips 10% in a single day, your first instinct might be fear. But if you stick to fundamentals, that dip is a buying opportunity. Your goal isn't to chase a dollar value. It's to add physical ounces at the most advantageous time. The market's manipulation works to create those opportunities. And here's where the herd mentality comes into play. New investors are coming into the precious metals market every day, and many are reacting emotionally to headlines. This is where education becomes critical. You must understand that silver and gold are not just commodities. They're monetary assets with thousands of years of history. Your stack is your personal insurance policy against fiat devaluation and systemic instability. If people buy just because of hype, they risk entering at a high and panic selling during a dip. Institutional investors are reading the structural trends differently. Sovereign wealth funds, central banks, and proprietary desks aren't chasing headlines. They're reading the charts, watching the ratios, and positioning for a long-term shift. And that's exactly what's happening now. Physical silver is moving into stronger hands. The retail investor may not even notice yet, but the structural story is unfolding quietly. Now, the conversation about CME and margin changes highlights another critical lesson. Rules can shift overnight, but fundamentals endure. When you measure wealth in ounces, these manipulations have no real impact on your long-term strategy. You continue to accumulate, and over time, these ounces translate into financial power that fiat cannot provide. Bart also reminded us of one other vital aspect: education. The more knowledgeable you are, the less likely you are to be swayed by the herd or short-term panic. Teach newcomers about the fundamentals. Show them why stacking silver is about participating in a new monetary system, not chasing speculative gains. The goal isn't to get rich quickly, it's to secure wealth that stands the test of time. So, as we approach 2026, this is your takeaway. Keep stacking, focus on weight, ignore the noise, and understand the forces shaping the precious metals market. Rule changes, margin calls, intraday swings, they're all temporary. The underlying story is silver scarcity, structural demand, and the inevitability of a new monetary reality where precious metals play a central role. And for those of you who are stacking already, remember this: every ounce you add today is part of a strategy that transcends paper currencies, market manipulation, and short-term headlines. You are not just investing, you are participating in the revaluation of money itself. Now, let's dig deeper into the silver versus gold dynamics, because this is where the real story unfolds. As Bart mentioned earlier, the silver to gold ratio has tremendous historical significance. For decades, silver lagged behind gold in terms of institutional attention, but that's changing rapidly. Today, silver is finally stepping into its role as both a monetary and industrial metal. And the structural breakout, we're seeing signals that this shift is no longer just theoretical. It's happening in real time. Look back at history. The silver to gold ratio has fluctuated dramatically over the past century. But the underlying trend has always been toward convergence when physical demand tightens. Right now, that convergence is accelerating. Industrial demand, investment demand, and sovereign accumulation are all working together. The physical market is being pulled from both ends. Industries need it, investors are taking it off the market, and supply is finite. You cannot ignore that this is a structural squeeze. Bart highlighted an essential mindset for investors. Don't measure silver in dollars, measure it in weight. Let me illustrate why this is critical. Suppose the price dips 10% overnight. If you're focused solely on fiat value, it feels like a loss. But if your goal is accumulating ounces, a dip is a bonus. It's an opportunity to add physical metal at a discount. This mindset is the difference between a panicked trader and a strategic stacker. Physical accumulation, ounce by ounce, builds real wealth over time, far more reliably than attempting to time short-term paper markets. Institutional behavior reinforces this trend. Sovereign wealth funds, central banks, and proprietary trading desks are quietly positioning for a new monetary regime. They're buying silver and gold not for speculation, but as a store of value and hedge against systemic risk. These players are invisible to the average retail investor, but their footprint is enormous. When you see inventory levels at major vaults declining, COMEX and LBMA stocks falling, and premiums rising on physical metal, that is proof that real, long-term accumulation is underway. And let's talk about scarcity. Physical silver is running out, plain and simple. Mine supply is constrained, recycling cannot keep pace, and industrial demand is growing. This imbalance between supply and demand creates pressure on price that paper contracts alone cannot manipulate. Margin calls, rule changes, and short-term squeezes can create volatility, but they cannot stop the long-term structural movement. Anyone betting against physical silver is swimming upstream against one of the most powerful market forces in decades. Another point Bart made is about herd mentality. New investors may enter the market in 2026, chasing headlines or the rising price. That influx can create temporary price spikes and volatility. But those who understand the fundamentals, who measure their wealth in ounces and stick to a long-term stacking plan, will not be shaken. Education is your defense against panic. The more you understand silver's role in a new monetary system, the less likely you are to sell at the wrong time. Finally, this is why diversification within precious metals is important. Gold remains a cornerstone, a stable reference for wealth preservation. Silver, however, offers both industrial leverage and monetary value. Together, they form a foundation capable of withstanding fiat currency depreciation, systemic risk, and market manipulation. Your stack should be strategic. Ounces of silver, ounces of gold, allocated according to long-term goals, not short-term price swings. In short, the story for 2026 is clear. Silver is breaking out structurally against gold. The market is tightening. Institutional accumulation is accelerating. And retail investors who focus on ounces rather than dollars will thrive. Don't get distracted by short-term noise. Understand the long-term trajectory, stay informed, and continue stacking. Every ounce you acquire today positions you for the inevitable shift in monetary systems tomorrow. Now, let's talk about the elephant in the room: market volatility, rule changes, and margin calls. These are the short-term shocks that can spook casual investors. But for those who understand the structure of the market, they are merely noise. Bart touched on this earlier. When CME changes margin rules or the exchanges adjust leverage requirements, it can create intraday spikes or drops. On December 26th, new margin perspectives were introduced, and by the 29th, silver experienced a sharp drop. By the 30th, prices recovered. What does that tell us? The market is being manipulated on the surface, but the underlying trend remains intact. Physical silver is in demand, and institutions are quietly buying. This is where strategy becomes crucial. Retail investors often panic during these spikes or dips because they focus on the dollar value rather than the physical ounces they hold. Remember, your goal is weight, not fiat. If your target is to stack 100 ounces, a temporary 10% correction doesn't erase your progress. It's an opportunity to acquire more metal for the same capital. This mindset is essential in 2026 as new investors enter the market chasing headlines. Those who stick to fundamental stacking principles will come out ahead. Institutional behavior reinforces this trend. Large players, sovereign wealth funds, central banks, proprietary desks are positioning for a systemic shift. They are not trading for short-term profit. They are securing physical assets as a hedge against currency devaluation and systemic risk. When you see COMEX inventories dropping, LBMA stocks declining, and premiums rising on physical silver, it's proof that accumulation is real. These institutions aren't influenced by daily news cycles. They are responding to structural signals that retail investors often overlook. Bart also highlighted the importance of herd mentality. As silver prices rise in 2026, mainstream media coverage will bring new participants into the market. Many will buy at high prices without understanding fundamentals, driven by fear of missing out. This creates short-term volatility, but seasoned stackers who focus on ounces rather than dollars will benefit. Education is key. Understand why silver is scarce, why it's needed in a new monetary system, and why price fluctuations are normal in a structurally bullish market. The scarcity of physical silver cannot be overstated. Mine supply is limited, recycling cannot meet industrial demand, and global stockpiles are shrinking. Unlike paper markets, where contracts can be created at will, real physical metal is finite. This scarcity is what drives premiums on bullion, especially when rule changes temporarily depress spot prices. Every ounce you acquire now has strategic value. It's a hedge against both systemic risk and inflation, and it positions you for the coming structural shift. Another key point is the diversification between gold and silver. Gold remains a cornerstone of wealth preservation, but silver offers unique advantages: industrial leverage, monetary utility, and explosive potential in a breakout scenario. Holding both metals ensures you are protected against fiat currency collapse while benefiting from potential parabolic moves in silver. Allocation should follow a long-term strategy. Focus on stacking ounces, not chasing dollar prices, and remain disciplined regardless of market swings. Finally, 2026 is shaping up to be a year of structural change. Silver is breaking out, not just in price, but relative to gold, signaling the start of a new monetary regime. CME rule changes, margin calls, and short-term manipulation may create drama, but they cannot stop the underlying momentum. Investors who understand the fundamentals, stick to stacking, and ignore short-term noise will be the ones who thrive. The key is to see past the headlines, focus on accumulation, and trust the structural signals the market is sending. In essence, this is a pivotal moment. Volatility is your friend. If you measure wealth in ounces, institutions are quietly accumulating, scarcity is tightening, and silver is finally asserting its role alongside gold. Those who act now, with discipline and education, will be positioned to benefit from what could be one of the most significant monetary shifts in decades. As we wrap up, let's focus on what this all means for you, the dedicated silver and gold stacker. 2026 is not just another year. It's the start of a structural shift in the precious metals market. What Bart and I have been discussing isn't short-term noise or hype. We're talking about a system-wide change where physical metals are reclaiming their role as true monetary anchors. Silver, in particular, is entering a phase we haven't seen in decades. After decades of being suppressed, manipulated, and overlooked, it's breaking out. We're already seeing supply stress, COMEX inventories dropping, LBMA stocks declining, delivery backlogs, and premiums rising on physical metal. These aren't temporary fluctuations, they are structural signals. Institutions, sovereign funds, and central banks are moving aggressively. When they act, it's a signal the market cannot ignore. This is why sticking to fundamentals is non-negotiable. The first rule is simple. Measure your wealth in ounces, not dollars. Price will fluctuate, headline stories will come and go, but the physical metal you hold is what matters. Your goal is accumulation, not chasing a high. If you're aiming for 100 ounces and a temporary 10% correction occurs, it's an opportunity to add more weight to your stack. The fundamentals of silver scarcity, industrial demand, and monetary utility remain unchanged. Next, understand herd mentality. As silver rises in price, mainstream media will spotlight it, attracting thousands of new investors. Many will buy at inflated prices, chasing headlines without understanding the underlying structure. Experienced stackers must stay disciplined, educate newcomers, and focus on long-term accumulation. Herd behavior can create short-term volatility, but it also presents opportunities for those who are prepared. Diversification between gold and silver remains key. Gold is the cornerstone of monetary stability, while silver provides leverage, both industrially and monetarily. Holding both ensures protection against fiat currency erosion, while positioning you to benefit from potential parabolic moves in silver. Don't focus on dollar prices. Focus on acquiring ounces and preserving wealth. Geopolitical factors amplify the urgency. When central banks act, global reserves shift, and nations rethink monetary policies, the market moves in response. The Russia reserve seizure, record central bank gold purchases, and India's record silver imports are just the beginning. These events signal a worldwide transition to monetary metals as a safe store of value. Retail investors alone cannot drive this market. It's institutional behavior that sets the stage for significant upward moves. Finally, 2026 is a year for strategic positioning. Ignore short-term headline volatility. Don't be distracted by temporary dips caused by margin calls or regulatory changes. Focus on fundamentals, stick to your stacking plan, and trust the structural signals. Silver is no longer the student. It's stepping into its rightful role, asserting its importance alongside gold. Those who are disciplined, educated, and positioned in physical metals will benefit as this multi-year, potentially explosive cycle unfolds. To everyone watching, if you haven't yet secured your place in the new monetary reality, now is the time. Accumulate ounces, maintain discipline, educate yourself and others, and prepare for the inevitable structural shifts ahead. This is more than a market trend. It's a generational opportunity. Remember, wealth in precious metals is measured in ounces, not dollars. Stay patient, stay informed, and keep stacking. This isn't about speculation, it's about securing your financial future in a world where monetary systems are evolving. Thank you all for joining us today. Make sure to subscribe, hit the like button, and share this knowledge with your fellow stackers. Keep stacking, stay disciplined, and prepare for an extraordinary 2026 in precious metals.